Chapter 7. Credit and Debt, a Guaranteed Investment. As you build wealth, two powerful forces can either work for you or against you: interest and credit. Understanding and managing both is crucial because they impact how far your money can go, how many doors open for you, and how confidently you can take the next step toward financial freedom. Paying off debt is a guaranteed investment. Most people don't think of paying off debt as investing, but it absolutely is. If you're carrying a credit card balance with a 20% interest rate, every dollar you pay off is like getting a 20% return, guaranteed and tax-free. That's better than most stocks or real estate deals you'll find. Even paying off a 10% or 15% interest loan is a win. That's money that no longer leaves your pocket every month. It's a step toward peace of mind and power, and it's one of the fastest ways to increase your disposable income and reduce financial stress. Paying off debt also boosts your net worth, not just on paper, but in terms of leverage. When you owe less, your options expand. You can save more, invest more, move differently. If you're deep in debt, start by allocating a small portion of your savings to debt elimination. List your debts, pay more than the minimum on one while keeping the others current, and knock them out one by one. Every payment you make toward your debt frees up your future. So instead of thinking, "I can't afford to pay off this card," flip it. "I can't afford to keep paying all this interest." Credit, a long-term investment in leverage. While eliminating debt boosts your freedom, building credit increases your access. A high credit score isn't just about borrowing. It's a form of financial credibility. It shows lenders, landlords, and even employers that you're responsible and low risk. But more than that, it gives you leverage. With good credit, you can get approved for loans and lines of credit, access lower interest rates, qualify for better insurance premiums and rental agreements, build business credit faster, use other people's money to grow your assets, and, best of all, you don't need to go into debt to build good credit. You just need to manage the credit you already have wisely. What makes up a credit score? Your credit score is made up of 5 key components. Understanding these helps you know exactly where to focus. Payment history, 35%. Pay on time, every time. Even one missed payment can cause a big drop. Set up auto pay or reminders so you never forget. Credit utilization, 30%. Keep balances below 30% of your credit limits. 10% is even better. Example, if your credit card limit is $1,000, try to keep the balance under $300. Length of credit history, 15%. The longer your accounts stay open, the better. Don't close old accounts if you don't have to. Credit mix, 10%. A combination of revolving credit, like credit cards, and installment loans, like car or student loans, can help, but it's not necessary. New credit inquiries, 10%. Avoid opening too many new accounts in a short time. Each hard inquiry can cause a small temporary dip. Habits that build and maintain great credit. Always pay at least the minimum on time, no exceptions. Pay early, not just on time, especially on credit cards. Keep your usage low. Try to only use 10 to 20% of your available credit. Check your credit reports at least once a year, free at annualcreditreport.com. Use secured credit cards if you're just starting or rebuilding. Don't max out cards, even if you plan to pay them off. Utilization is calculated throughout the month. Think of these habits as daily deposits into your credit investment account. They may seem small, but they compound over time, just like interest. If you need to repair your credit, bad credit isn't the end. It's just a signal that some things need adjusting. You can rebuild. And it starts with a plan. Here's a roadmap. Pull your credit reports from Equifax, Experian, and TransUnion. Look for errors, outdated information, or fraudulent accounts. Dispute any inaccuracies. You can do this online for free. Catch up on any late payments and bring accounts current. Start using a secured card to reestablish positive payment history. Avoid closing old accounts, even if they're inactive, unless they're charging you fees. Negotiate with creditors. Ask for a payment plan or even a pay-for-delete agreement. Be patient and consistent. Real repair takes 6 to 12 months or more, but it works. Every month you stick to your plan, your credit improves. Every improvement expands your access and opportunity. Credit as a wealth-building tool. When your credit is strong, your financial world gets bigger. You can borrow to buy assets. Use business credit to build something of value. Access better terms, lower fees, and higher limits. You don't need to worship credit, but you do need to understand how it works. Treat your credit score the same way you treat your physical fitness or your investment portfolio. Monitor it. Feed it the right habits. Give it time to grow. Done right, your credit becomes one of your strongest allies on the path to wealth. Action step. Put your credit and debt strategy into motion. Get your free credit report. Visit annualcreditreport.com to download your credit report from Equifax, Experian, and TransUnion. This is free once per year from each bureau. Look for any errors, outdated information, or suspicious activity. Check your credit score. Use apps like Credit Karma, Experian, or your bank's mobile app to view your score and get real-time suggestions. Understand what's helping and hurting your score based on the 5 factors discussed earlier. Analyze your debt. List all current debts, including total balance, interest rate, minimum payment. Sort them using the snowball method. Start with the smallest balance first. Or avalanche method. Start with the highest interest rate first, whichever keeps you motivated. Allocate a portion of your savings toward debt. Choose a fixed percentage of your savings, e.g. 10 to 30%, and begin using that to eliminate debt. Make more than the minimum payment on one target account while keeping others current. Once it's paid off, roll that same payment amount onto the next. Stabilize your current credit usage. Reduce your credit card balances to under 30% of your available limit. 10% is ideal. Set up auto pay or calendar reminders so you never miss a payment. If needed, ask for credit limit increases to lower your utilization. Just don't increase spending. Add positive credit activity to your profile. Open a secured credit card or credit builder loan if you're starting over or new to credit. Use services like Experian Boost or rent reporting tools to add utility and rent payments to your credit profile. Keep your oldest accounts open, even if unused, unless they charge high fees. Make credit health a monthly habit. Treat your credit the way you'd treat your physical health or business finances. Monitor it monthly. Make strategic moves, not reactive ones. Celebrate improvements, no matter how small.